All right, greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. So today I want to talk about a trade that I put on April the 22nd. So today is May the 1st. So I put this trade on April the 22nd, and the trade was implemented essentially outside of my trading rules, right? And so one of the main rules that I have regarding my trading is that I don't look to put on a trade until the SPX, which is what I primarily trade, the SPX 0 days to expiration. Sometimes I do 1 or 2. But I don't look to put on a trade until the SPX has made at least a 20-point move above or below the opening price. And the reason being is because I like this, so I look at money as an abstract form of energy. And so when the SPX makes a 20-point move above or below the opening price, from my perspective, that's a major expenditure of energy, right? So just looking at over the last 23 years, we can see here on this chart here that the SPX, when it's moving from the opening price to its highest price of the trading session, that highest price normally is roughly 30 points or less below the opening price on any given trading session for this particular time period. So looking at 23 years of SPX historical data, the SPX will make a 30-point move above or less the majority of the time of the opening price. And so the fact that I like to wait until the 20-point move, essentially when that move takes place, that is the majority of the move to the upside, oftentimes, but not all of the time. But that is the majority of the move to the upside for the SPX. And if the implied volatility is high, right, essentially it's just a matter of getting beyond the SPX's move to the upside. And I like to use my levels of interest, 1, 2, and 3 on the upside and 1, 2, and 3 on the downside. But nonetheless, just getting beyond the SPX's move to the upside after it has made that 20-point move puts you in a position where you have a high probability of walking away with the money. Now notice I said high probability. I didn't say certainty. I said high probability of walking away with the money. So on April the 22nd, because I won so many trades, I figured, hey, let me just jump in before the 20-point move. And so I put this trade on April 22nd. So my short strike was at 50.25 and my long strike was at 50.30. Normally I do a $5 wide credit spread. Right, so I got into this trade right here on this candle here that you see that's shaded in gray here. And so I got into the trade at a roughly 11:56 a.m. Eastern Standard Time. Now, mind you, the 20-point move hadn't been made, but I just assumed that, again, I'm breaking my rule, and there are consequences. There's a consequence when you break your trading rule, right? And so I got into the trade early, and things were going well. It wasn't until 1:24 p.m. Eastern Standard Time that the SPX made that 20-point move above the opening price. Now, I was at 50.25. The 20-point move was made at 1:24. So we're talking about roughly 50, 50-15, 50-14, if you will. So it was roughly within 10 points of my short strike at 50.25. So now I had a decision to make. I could either close the trade out for a loss. I think the loss would have been like $600, and I should have done that, or I could roll because my SOP, if you will, is to roll if the SPX is within 10 points of my short strike. And so it was, and so I rolled to, and I actually had to increase the width of my credit spread from 5 to 10 in order to get a decent credit. So I rolled to 51.05 and 51.15 to April 30th. You know, the SPX continued to run up. Now check this out. Now on that same day, after I rolled this position, because the SPX had made a 20-point move, now my perspective was different, right? So my perspective was different. Thus, I was able to put on another trade that same day, that same expiration date at 50.25. And I put that trade on at 1:46 p.m. Now this trade should have been my first trade. This trade should have never been implemented. Why? Because I was violating my trading rule of waiting until the SPX makes that 20-point move above the opening price. So this should have been my first trade and only trade. But nonetheless, so I rolled this trade. I put this trade on 50, 55, and 50.60 at 146. And as you can see here, the closing price for the SPX that day was 50.10.60. Now, had I stayed in this trade, I would have walked away with the money because, as you can see here, the price of SPX closed below 50.25. But I didn't know that was going to happen, right? So I can't make any assumptions, although I did make an assumption on this trade, but I can't assume that the SPX is going to hit resistance in reverse and come back down below my short strike of 50.25 or just that entire credit spread. And so I rolled and I increased the width of my credit spread from 5 to 10, but I walked away with the money on this trade. So long story short, I ended up rolling this trade 2 more times. I ended up capitulating and to say, you know what, I'm just going to close this trade out for a loss. So I ended up losing on this trade. Let me just do this. I ended up losing $2,125, right? Because I broke 2 of my rules. So I should have just closed the trade out for a relatively small loss of $600 when I had the chance, but instead I rolled the trade, increased my risk from a $5 wide to a $10 wide credit spread, rolled it 2 more times, ended up just capitulating and closing out the trade anyway for a $2,100 loss, right? Now, the money will be made back. That's not a problem. But my point is, you know, when you develop an edge, when you find an edge in the market, and you develop these rules in order to experience, you know, from my perspective, longevity in the trading space is you have to be disciplined and adhere to your trading rules. Now, 98% of the time, I'm extremely disciplined and I adhere to my trading rules. But on this particular day, you know, somewhat arrogant and just put the trade on before the SPX made a 20-point move, and I paid a very expensive price for it, or a relatively expensive price for it. You know, so but that's trading. You know, you live and you learn. But nonetheless, being disciplined and being extremely humble when it comes to trading is extremely important. But yeah, so I just wanted to convey or to discuss this particular trade because, you know, oftentimes I see a lot of traders talk about their wins, but they don't talk about their losses very often, and we all have losses. I don't care, how much money a trader makes on one trade. It could be 45,000, whatever. There are going to be days where they're going to have a loss, so I don't want to give the impression that trading is all about just making money. You will have losses. As a matter of fact, most people actually, blow accounts up, meaning that they lose all of their money in their account, sometimes once, sometimes a couple of times before they actually become successful. Fortunately, I have never blown up an account, but I have lost a significant amount of money over the years, and I have learned from those losses. But nonetheless, I love trading, and my rules, as long as I abide by my rules, really serve me well. And so again, once you guys develop your trading rules, and if your rules actually work, they give you an edge in the market, stick to them. Stick to them.